Hello and welcome to everyone for our webinar today titled Investing in the Current Environment. My name is Justin Brown. I'm the Director of Investments here at Greenspring Advisors. I'm excited to be joined today by Apollo Lupescu. Apollo is a Vice President at Dimensional Fund Advisors, one of the premier investment managers in the world, managing over $800 billion in assets. He's a globally recognized speaker who has delivered hundreds of lectures and seminars to financial professionals and investors on a variety of investment topics. Apollo is kind of considered the secretary of explaining stuff because he has a knack for explaining complicated issues in a clear and understandable way. Apollo has been with Dimensional in Santa Monica for over 20 years, and prior to that, he taught at the University of California. He received his PhD in economics and finance from UC Santa Barbara. Apollo also holds a bachelor's in economics from Michigan State University. Apollo, I know I speak for everyone here on the call today when I say thank you for being here, and I'm looking forward to the discussion.
Well, hi, Justin. Thank you so much for the invitation, and thanks to everyone for taking the time. I'm looking forward to this conversation as well. A lot to talk about.
Yeah, certainly is. And on behalf of everyone here at Greenspring Advisors, to everyone who's joined the call today, we want to thank you for joining us as well. We hope you find this discussion insightful and interesting. Now, before we get started, there's a few housekeeping items I want to make you all aware of. First, this webinar is being recorded, so after it concludes, you'll receive a copy of the recording. Now, we did receive a good bit of questions beforehand, so thank you to everyone who submitted those. If you did not submit a question, but you have one now, or one comes up during the call, on your screen, you should have a Q&A box. So as questions arise, feel free to enter it here. We'll look to cover as many of these as we can throughout the discussion today, and if we can't get to your question, we'll circle back with you afterwards to make sure we're able to do so. Also, if you have any technical difficulties or prefer submitting questions this way, please feel free to reach out to us at info@greenspringadvisors.com. Again, that's info@greenspringadvisors.com. So as we move into today's discussion, it's important to acknowledge that markets have seen some increased volatility over recent days and weeks. We certainly will dive into this throughout our time today, but I wanted to start things off by saying that volatility in markets is not something that's new. It's something that we've seen throughout the history of markets, and when designing portfolios, something we plan for and intentionally add components to help provide diversification. Markets have experienced many ups and downs over time, so it should not surprise us when this occurs. And while most of our time today is going to be dedicated towards some of the more near-term factors and things going on in markets, I just want to encourage you all to zoom out a bit and see that we've had a few very strong years in markets recently. And the further you zoom out and extend your time horizon, the smaller each dip in markets becomes. Above all, what we know is that markets have shown resiliency over time and have delivered immense value and rewarded investors that have kept a long-term focus and stayed the course. Well, let's jump into some of the questions we had for today. We're almost 50 days into President Trump's second term, and regardless of if you agree with what's going on or if you disagree, I think we can all agree there's a lot that's going on. Perhaps what have made the most headlines are tariffs. Apollo, can you talk about these tariffs, kind of what's in place, what might be on hold, more importantly, how should we be viewing these tariffs and their impact on markets as investors?
Yeah, for sure. No, it's a really big topic, and I'm glad you brought it up because it is every day in the news that you hear about tariffs, and then there's a sense of anxiety because none of us are really exactly sure how is this impacting us as individuals, the world, but also our portfolio. So I'm gonna start maybe, Justin, if you don't mind, just making sure that everybody has clarity around what exactly are tariffs, because even within my family, and they're very sophisticated folks that I know, they're like sometimes like, what exactly is a tariff and how does it work? So let's use a real example, practical example of some sort. So let's say that you are Costco, and I'm just gonna use some company names, no necessarily like don't read much into the names that I use, just to make it a little more relatable. And Costco would like to put maple syrup on the shelf in their warehouses. So Costco at that point goes to find some producers, and it turns out the majority of the maple syrup is made in Canada. So they go and they find a producer in Canada, and the producer says, well, I'm willing to sell you a bucket of maple syrup for about $20. And Costco says, okay, I'll take that maple syrup for $20. And I also need to add some margin, some dollars to cover my warehouse expenses, electricity, and so forth. So they put on the shelf for $24. So they add $4 to put on the shelf. And that's in the world of no tariffs. So we go pick it up at the store for about $24. Now, when tariffs are imposed, as we talked about recently, tariffs against all products coming from Canada at about 25%. So let's say that that's the case, and now there is a 25% tariff. The way that a tariff works is that the company that brings in the product in the country, not the producer, but the company bringing in the product in the country, in this case, Costco, is responsible for sending the government a check or money that amounts to about 25% of the value of the product. So if they buy the maple syrup of $20, 25% of that is roughly about $5. So they are now responsible to sending the government $5. So where is that $5 going to come from? Well, in one scenario, you can go to the producer and say, listen, why don't you sell me this maple syrup for $15? And then, you know, when you put in the $5 on top of it, I can get it back for $20, put it on the shelf for the same price like it used to be at $24. That's one scenario under which the foreign producer pays for the entire tariff. Now, if all the maple syrup comes from Canada, or the majority of it, it's going to be a hard push to say, well, you know, lower your price, producer. So the producer might say, no, I'm not going to lower my price. That's what it takes for me to produce this. It's $20, take it or leave it. So Costco now comes and takes it for $20 because it doesn't have as much bargaining power. It's not like they can buy maple syrup from somewhere else. And now they have to decide, well, where do I get the $5 from? In one scenario, they say, well, we're going to eat this because we want to keep it on the shelf for $24. Well, even in that case, they still need to collect more money because that means they would have no margin, no profit whatsoever. And they would have to also put another dollar to send to the government. So that's not going to work. The producer paying the tariff. And the alternative scenario, the last scenario, is that if the producers don't pay it, if the importer doesn't pay it, then what Costco has to do is say, well, I have to charge now $20 the producer, plus I have to collect the additional tax of $5 from the customer, and then I put on my own $4 on top of that. So now the price of maple syrup goes from about $24 to $29. So here's kind of like what I'm getting at. A tariff is basically, it's a form of a tax. And instead of paying a sales tax that goes to the state, in this case, you pay a federal tax because the product was made somewhere else that gets sent to the federal government. Who pays that tax? There are three parties involved: the producer, the importer, and the customer, the consumer. And what we've seen in the past, when you look at, for example, washing machines, is that when a 20% tariffs was imposed for washing machines coming from abroad, what economists found is that about 12% out of that 20, so more than half of that tax, was passed on to consumers. And the rest of about 8%, there was a split between the producers taking a haircut and maybe the importers taking a haircut. So what you're likely to see possibly is that some prices go up. And which prices would go up depends on how things are being produced. If pretty much everything is being produced abroad, like 80% of the avocados are made in Mexico, and you have maple syrup from Canada, you have shoes that come from China. Well, it's not easy for an importer to find an alternative source, so it's likely that the prices are going to go up for those products. And the way that this split happens between the producer, the consumer, and the importer, it just really depends on the product itself. But by and large, what the economists are expecting is that prices are likely to go up. So that's one implication of the tariffs. The second implication of the tariffs is that sometimes when you put a tariff, let's say against steel, what you could do is protect steel. And that is one of the reasons why these tariffs might be put in place, is because you have a need to protect a certain industry. And what we've seen last time it happened in 2017, what we saw is that this particular this particular type of policy of trying to protect the domestic industry did help to some degree create jobs. We talked about washing machines. We did find that the estimates were that tariff did bring in American jobs. So it was estimated that about 1,800 jobs were created in the country. What's interesting, though, is that the cost to all of us ended up being about $800,000 per job brought in. So it's not clear, in other words, that's it's all benefit. No, because when you impose tariffs, the consumers pay more, they have fewer choices, and it creates perhaps a snowball effect. When you have steel imports now being more expensive, what tends to happen in other industries down the line might be less competitive, and they might lose jobs. So, so to put a little package, the tariffs are a tool that has been used in the U.S. by many years, actually from the inception of the country. And one of the reasons for that is because we want to protect certain industries, and that's certainly important to politicians because the people who are being hurt by foreign competition, they tend to be very vocal. That's one of the reasons. The second reason that you might hear is revenues. And it's absolutely true. In the early days of the country, from the beginning to about the Civil War, roughly 90% of the taxes that the federal government collected came from tariffs. But something changed at the time of the Civil War, and that's when we introduced the income tax. And as income tax became the primary way for the government to generate money, today we went from 90% of the founded when the country was founded in revenues of coming from tariffs to roughly about 2%. So very big difference. Is not a big part of the revenue base of the government. So it's a combination of factors why somebody might say we want to have tariffs. It's the revenues, it's protection of local of domestic companies, and sometimes it could be reciprocity. If you feel like somebody is not treating you well, what do you want to respond in kind? And that could be a third reason. But by and large, what I can tell you folks is that tariffs, we have seen they raise prices for consumers, and in what product depends on the dynamics of that industry. We do see that in some cases the argument of revenue is being brought forth, but today it's such a small part of the government revenue that it doesn't really hold that much water. And these tariffs that we're seeing today, they're not really they don't seem to have a very clear agenda, like what exactly are we trying to accomplish? Because I'm not sure there's a flood of immigrants coming from Canada or a lot of fentanyl. So some of the reasons I'm not necessarily an expert to be able to tell you, but intuitively I'm not sure what the end goal is. Now let's ultimately talk about, Justin, about what does it mean to you as an investor? Should you be paying attention, and could this benefit or even hurt you as an investor? And I mentioned steel. If you go back to the early days of the first Trump administration, that's when you can look at a company that carries the name of that industry. It's United States Steel Corporation. So if you go back to those days, what you see, interestingly enough, is that the stock price for U.S. Steel just dropped significantly. It tanked. Within a short time, it went from over $40 a share to less than 20, lost more than half of its value. And when that happened, a lot of folks were concerned, like this is not good. And then the administration started talking about the steel tariffs against foreign producers, and that would give U.S. steel a huge competitive advantage. And one of the things that we see in investing is that on expectation, before a policy gets even enacted, we do see that the price increase perhaps on those expectations. And it's a very big lesson for all of us today. The stock market has already priced in the expectation of tariffs the same way that it did back then, even though the policy might not necessarily be enacted fully. So when you hear a lot of the talk today about tariffs, well, I can tell you folks that one of the big lessons for investors is that market has already priced in anything that is expected the same way that it did back then, with no clarity if the tariffs are going to come in. And they did come in March of 2018. we did see tariffs imposed against foreign producers. And the seductive narrative at this point, where boy, this government, this industry, this company has the full backing of the U.S. government, so maybe that's the time to invest. And the second big lesson for all of you is that one is that prices already reflect the expectation of benefit or detriment from tariffs. But number two, tariffs are one of the many variables that actually resulted in an outcome for an investor. In other words, they are not the primary driver of a company's success or failure. And if you look at U.S. Steel, with the full backing of the government, between the time when the tariffs were imposed and when the administration lost the election in November of 2020, U.S. Steel pretty much lost the vast majority of its value, despite having the backing of the government. So just a little word of caution. I wouldn't go too far to say that it's a good thing or a bad thing for an investor to have these tariffs, because it is not clear at all. Now, what about the stock market as a whole? And we can look at the stock market again during the first Trump administration, when we did have these big tariffs, and we did see that pretty much day after day back then as well. We saw headlines around tariffs. And if you go back to those 4 years, there was just so much around tariffs. And if you look at how did the U.S. stock market do during these 4 years of pretty intense talk on tariffs, well, $1 invested at the beginning of the Trump administration by the end would have turned into $1.80. So basically an 80% increase in the value of your investments in the U.S. stock market, despite all these trade wars and everything that we had pretty much the same time around back then. Now, what's interesting is that the country that we targeted, Justin, was China. And we really wanted to punish and inflict some pain on the Chinese economy and the Chinese market. And during the same exact 4 years, the Chinese the Chinese economy and the market was really impacted by by these tariffs. And as an investor, you might want to be cautious, because that's kind of the conventional wisdom. And over the same exact time frame, the Chinese stock market did not go up 80%. In fact, the Chinese stock market went up 100%. It outperformed the U.S. market despite the tariffs. And that kind of goes to the point that I made earlier, is that tariffs are one of the many variables that impact the performance of any one company or the market as a whole, but it's not a primary driver. And because of that, we really don't recommend that investors make a change to their allocation or try to become pessimistic or optimistic, but rather just say this is one of the many variables. And to the point that he made earlier, perhaps it's a better strategy to stay disciplined rather than react to the emotions of investing, of the reality that we see right now.
Yeah, that's super helpful, Apollo. Thank you. I think what I'm hearing from that too, just to kind of put my own spin on it, is tariffs are a tool that have been used forever in the U.S. Essentially, there's different reasons, from revenue to protection to reciprocity, that they might be implemented this time around. Obviously, they can look a little bit different each time, but what we've seen from an investment standpoint is they're not typically a primary driver. They do contribute at times, but they're one of many variables that are going on in the market at a given point in time. And I think a secondary question to this, and you did touch on this some, but I think the big concern, and ultimately for a lot of investors around tariffs, is, well, what does that mean for inflation? How can we think about this from an economic standpoint? Are there any insights that you have as far as what the actual impact of tariffs will be on inflation? And then I think lastly, how does this impact the Fed and interest rates? So a very loaded question, but.
Yeah, a lot of questions. So let's start with the first one. And I think it's a really important one. And Justin, you alluded earlier at what you do for your clients in creating a plan. And I have to say that over and over, what I've seen, and I've known you folks at Greenspring for a long time, is that there's a great emphasis on a plan. And the reason I want to talk about the plan is that the plan, when it is built, It is built to withstand periods of low inflation, high inflation, ups in the market, downs in the market, and it's built robustly enough where it's not like the the little plane that you see on Discovery Channel with like all little wires, and if one breaks down, the whole thing comes down in flames. That's not it. This is a tank. It's designed to really take you through these times. So it is built to withstand inflation, should the inflation get there. So just an acknowledgement there that it is important. Secondly, you mentioned the Fed. And I think it's really important to talk about the Fed because the Federal Reserve is the central bank of the United States, and they have a specific mandate to make sure that prices are stable, and they take that very, very seriously. And just to kind of reflect a little bit of how seriously they take it, we can go back a little bit in time and look at the interest rates that we saw in the economy. And I'll come back to that in a second. Let me start with just a perspective, a long-term perspective that would give you a sense of interest rates and how they tie to inflation. If you look over the long run in the U.S. History, the economic history of the country, the way that the government borrows money is through something called bonds, which a bond is a form of a loan where, let's say, Justin lends the government the money for a period of time. He receives interest for that time, and then at the back end gets the money back. And one of the very important features of this type of a borrowing that the government does is maturity, meaning how long is the length of the contract. Because quite often what we see in the data is that this particular length matters when it comes to the interest rate or what's technically called the yield that investors receive on their money. And let's say that you want to give the money to the government for 30 days, which is very short. After 30 days, you get your money back plus interest. There's a particular interest rate that he received. And historically, looking at the data, investors really haven't demanded a great interest rate for this very short time, particularly dealing with the government. Now, if they're going to give the government the money for a year longer, so there's money locked up a little bit longer, traditionally investors have expected a higher interest rate. And they said, give me a little bit more for 1 year. And obviously, as you go to 5 years and your money's there even longer, you want a little bit of a higher interest rate. And longer term bonds like 10 or 20 years have typically given investors a higher rate to compensate them for their money being tied up. And if you draw a line through all of these, you get to something that in technical jargon is called the yield curve, which is the relationship between the length of the contract in the bond and the interest rate. And this is what's called the normal way, because it kind of makes sense. The more the longer the money is locked up, the higher the rate. Now, what's fascinating, Justin, is that when inflation came about in 2022, we saw two things that happened. They're, unusual, but not unprecedented. And the first one is that we saw a huge jump of these rates for 30 days and shorter from about, close to zero to over 5.5% or so. So it was a very big jump, not the biggest we've seen. The biggest was in the 80s, about 18%, so a lot more. But the second unusual thing that happened, which is quite interesting, is that if you lend the money for longer, let's say about a year instead of 30 days, you would get paid less. If you lend the money for 5 years, you get that paid less, and about the same for 10 to 20 years. So we still had this yield curve, but instead of being normal, it was now called inverted because it's a bit upside down. Again, not unprecedented, but quite unusual. And why am I bringing this up? You hear so much about the Fed, and inflation and interest rates. And it turns out that one thing that investors need to understand is that the Federal Reserve impacts the very short-term rates. These are roughly at about 30 days. That's kind of what they impact, the very short-term rates. And at the end of last year, we saw 3 cuts that impacted this rate. That it went to from about 5%, and it's just now lower because of these 3 cuts. And we did see this. And the implication for this cut is twofold. One, if you are investing in money market funds or CDs, certificate of deposits from the bank, by the way they're built, they have to invest into these very short-term types of instruments. And when the Fed cut rates, these rates also went down. So the CD rates, the money markets rate went down. And that's one of the things that we saw is that the rates came down. And if you're a saver, that's not necessarily a great thing for you because you're not going to get those great CD rates. But if you're a business that has to take these very short-term loans, that's a really good thing for you. So that's the first thing that we notice. So it's really important to note that the Fed impacts only these very short-term rates. But what about the longer-term rates? Well, for example, in the fall of 2023, when we were dealing with this big inflation, the interest rate on a longer-term bond, let's say the 10-year bond, was roughly about 5%. So it was roughly about 5%. It was what it is. But by August of 2024, and this is before the Fed started to cut rates, and this is what I mentioned earlier, these rates, before the Fed made any move, these rates went down to about 3.6%, significantly lower by a lot more than the Fed ended up cutting for the rest of the year. But this is before the Fed even cut rates. And what's fascinating is that by the end of 2024, these rates are up to about 4.5%, despite the fact that the Fed had increased rates. So really interesting to see out there that the short-term rates did exactly what the Fed wanted to do because those are the rates impacted by the Fed. But these longer-term rates, they did not do what they were supposed to do. They actually went exactly the opposite. They went down before the Fed made any cuts, and they went up after the Fed made the cuts. So what's the intuition here? What's the idea here? And to really understand what the idea is, you have to know that investors, when they lend money for a longer period of time, what they want to do is at least be able to buy the same things that they're buying today. So one of the things that these longer term rates incorporate is the expectation of inflation. What's the expected inflation? And adjust the rates based on that expected inflation. So if you now look at, for example, at in September when we had sort of that presidential debate, at the time the average expected inflation in the U.S. was roughly about 1.9%, so a little bit below 2%, which is the Federal Reserve's target rate. So everything was looking swell, everything was great. Now by last month, that expectation had increased quite significantly from about 1.9 to about 2.6. A variety of reasons, and a lot of investors and economists are saying perhaps the tariffs might cause that inflation to go up. And that's the bad news, but I'll also tell you the good news in a minute. But we did see that there's an expectation, and this rate went up by about 0.7%. And what's fascinating is that if you look at the interest rate on these 10-year treasuries that I mentioned, they basically went up in lockstep at about 0.7%. So you do see that perhaps these longer term rates are impacted by the expected inflation and the change in expected inflation, and perhaps that was one of the drivers of these higher rates on government bonds. And the reason they matter to all of us so much is because if you look at the long-term history of these 10-year treasuries, the 10-year government bonds, and then you overlay the mortgage rate, it's pretty visually obvious that the mortgage rate is based on the 10-year treasury. There's a difference there, is what's called a spread, but fundamentally it moves pretty much in lockstep with the 10-year treasury. So when these long-term rates are driven up by the expectation of inflation, perhaps one of the resulting actions might be the mortgage rates also going up. And in fact, what's fascinating is that if you look at the mortgage rates over the exact same time frame, they also increased by about the same amount. So the reason I brought this up, Justin, is because when we talk about inflation, the Fed has a big role in fighting it, and the Fed mainly impacts these short-term rates. And we should know that. But when it comes to these longer term rates that also have an impact on all of us, like for example, through mortgages, these rates are not really driven by the Fed as much as they're driven by the expectation of inflation. And we've seen that increase. And the good news that I mentioned earlier, when you have tariffs, it is not a structural change that month after month after month will lead to increases in inflation, but rather when tariffs are imposed, you see a bump up. So the whole price level goes up. And then from there, there's no reason to believe that it's going to continue to go up, but rather we just move the baseline from here to here. And from there, it could continue at the same rate as if there was no tariff. So it's not a continuous increase in inflation, because unless we have new tariffs, if you just simply have a one-time shock to the system, it moves the baseline up. And from that point on, it ought to grow at the same rate as it did before.
Yeah, definitely a good point there, Paulo, that when we hear the CPI or the consumer price index, you're typically thinking about that as year-over-year price increases and the rate of increase.
Right.
However, tariffs are a more one-time approach.
Exactly.
Or impact to inflation. And obviously, I know inflation is one of the main things that are on people's minds right now. And I think that was a very helpful framework to think about for it. From our perspective, a couple of things that I would add from Greenspring's perspective is that, one, inflation is one of the many risks that when you build a well-diversified portfolio, you're trying to protect against. There's no doubt about it. It's an important factor to consider. But as we mentioned earlier, it's one of many factors that you're trying to build a portfolio against. So it's top of mind right now, given that we came out of a higher inflationary environment than in years past. There's potential risk to increase inflation from tariffs, but it's important to view your investment approach as a balancing act, not to lean too far into just protecting against inflation or locking in a certain thing, but you want to balance the risk of inflation versus all the other risks that you're trying to handle when building a portfolio. And then secondhand, I would say, as far as how we design portfolios here at Greenspring, there's a few things that we incorporate that I think help to protect against inflation. First, and maybe this goes without saying, but over the long term, one of the best hedges to inflation is actually a diversified global stock exposure for your portfolio. If you think about it, if prices go up in the example that you gave earlier, a lot of times that's passed through to consumers. So businesses are still able to kind of deliver on their objective to innovate, to add value over time. On the short term, there could be some bumps, but long term, equity exposure is a way to help diversify that. And then I'd also say too, when you build a global portfolio, like we have at Greenspring, you're investing in countries, over 40 different countries with thousands of different stocks. If some do poorly, others are going to be there to provide ballast. Similar to if you look at this year, for instance, obviously the markets moved today, but through Friday's close, the US market was down about 2%, international developed stocks up about 10%, emerging market stocks up 3 to 5%. So there's different levers in your portfolio that can balance each other out and help to fight off inflation. And then real estate stocks are another thing we include in our portfolios. They're typically strong performers when inflation is around. And then on the fixed income side, I think having a broad diversification across that yield curve that you showed earlier is important to invest that way. But specifically, one of the levers that we have in our portfolios that helps against inflation are Treasury inflation protected bonds. So essentially what those are government-backed bonds that are linked to inflation with the goal of providing a real return, which is kind of including the inflation element to your return. So if inflation goes up, those bonds will also go up in value. And with that, their coupon or their payment will go up as well. So it's another lever that we have incorporated into our portfolios. So this is all just to say that inflation is definitely an important topic, but it's something that I think needs to be balanced on the risk scale. And, when you build a global diversified portfolio, it's something that you are protected against in that manner.
And Justin, what I just to add, I think it's so smart because to your point, there are multiple levers, and I think that the ones that he just mentioned, the Treasury inflation, the stock, the global, you go back to 2022. Remember how much inflation got to be in those in 2022 and early 23? You're talking 7, 8, almost 9%, and that was very, very high. And those levers that you're talking about did a phenomenal job. And today we're not talking about like what it was even 3 years ago. So let's put some perspective that the numbers that we're seeing right now, it's 2.5% expected inflation on average over the next 5 years. We're not talking about 9% what it was 3 years ago. So, folks, I mean, I know it sounds scary out there, but these portfolios, what Justin mentioned, are really built to protect you, and they protected you in those days of very high inflation. So certainly, we're not near where we were 3 years ago.
Yeah, definitely important perspective to keep in mind. All right, Apollo, I'm gonna ask you to go inside your crystal ball here. So, of all the policies that are being talked about, everything that's out there, in the news and the market that the Trump, office announces, day in and day out, do you think net these are going to be good or bad for the economy? And ultimately, are these going to result in the stock market going up over time?
Yeah. Well, I have to say that the first thing, before I get to those, it's an observation from talking to a lot of investors that the last few weeks have touched a nerve, and there's some anxiety because I feel like some of these policies are touching our on our deeply held beliefs, our core identity as individuals in some cases, and because of that, they trigger some very, very strong emotions about how you feel about what's going on in the country, the direction. And some are ecstatic about it, some are anxious about it. So people are feeling all kinds of ways about what's going on in the country. And even folks on this call probably have very divergent feelings on that. And I have to say, it's very legitimate to have those feelings. Our job, Justin, ours, is to acknowledge those emotions and at the same time take a very pragmatic look at how it impacts the economy and the stock market. And we don't want to be cold. We're not like Gordon Gekko, greed is good. It's just that we want to be pragmatic when it comes to your money. And one of the observations that I think it's important to note is that so many of the policies and what you've heard over the past few weeks are relevant to all of us. And at the same time, they don't have a huge economic impact. When you're talking about diversity and inclusion programs and being cut, I'm not sure that that's a main driver of the economy. When you're talking about the USAID not getting funding, it's hurting certain people who used to work there. It might be hurting people in Sudan and people all over the world. It's just economically, how much is it impacting us today? When you hear about cuts to the federal staff, the federal government staff. Well, one note is, and you're in the DC area, there are 2.4 million jobs at the federal level. If a few thousand job gets cut at 0.0% of something, it's not a huge number. But you talk about these cuts and all that. When you actually look at what's being done, a lot of it is really not as impactful as our emotions make us feel. And quite interestingly, when you think about the economic impact, it's quite minimal because you're seeing companies like, Facebook or Coca-Cola, McDonald's, all of these companies, they're kind of operating the way they used to. And the main driver of the stock market results are the expected profits of companies. And all these policies, except for some of the trade, they're not really impacting them that much. Now, what about trade policies? Could that potentially lead to consequences? Absolutely. Firms need to reshuffle some supply chains. And we've seen this. When the first time around, President Trump came around in 2017 and imposed these tariffs, companies start making things in China and made it in Vietnam or Cambodia or some other country, but they really didn't bring that many jobs at home. And we expect some of the same things to be happening today. So to answer your question, a lot of what we're seeing, there are more social issues. There are other issues that are not really impacting the business as much as it impacts our emotions. And because of that, I want to caution folks not to read too much into this. Companies are still free to pursue profits the same way that they used to be. Frankly, Justin, 4 years ago, when I would travel the country, in some regions, people would be very, very scared that what if we elected a socialist president that would not allow us to do business anymore? And they're very concerned about that. And today it's a little bit different. Like, yeah, you can do whatever you want. And it's more like buyer beware. So again, even if you look at Bitcoin or the coins that the crypto that the government and the president is not government, the president is promoting all that, that's something that maybe you don't feel right about it. Maybe you do feel right about it, but ultimately, what's the impact on Coca-Cola, McDonald's? And the last part is that you mentioned international. It is so important today not to be only invested in the US. Because if these U.S. car manufacturers are being impacted by these tariffs, and you hear so much about how detrimental they can be, well, you're also going to have not just Ford and GM and Tesla, but you're going to have some BMW, you're going to have some Toyota, you're going to have some Land Rover, some Jaguar, some Volvo. And these are global brands that are traded somewhere else, and they're certainly not likely to be impacted as much as perhaps the U.S. automakers, and that's a really important consideration. What you just mentioned, be globally diversified in 40 different markets.
Yeah, that's great perspective. It's almost I like to, as much as possible, try to separate, the personal impacts versus the investment portfolio. Obviously, both are very, very important, but from an investment standpoint, trying to bring things always back to like, how will this impact businesses? And I think as investors, obviously it's hard to predict what the future holds in any environment. But I think what we can control is what we need to focus on. So from an investment standpoint, what I think about is selecting research and evidence-based investments, targeting investments that have low costs, are efficient from a tax standpoint. When you design your investment plan, have a financial plan, stick to that financial plan. And then really from an overall perspective, have a broadly diversified portfolio. And then I think from a behavioral standpoint, there's also things we can do as well. And we've touched on some of these throughout the call, but staying the course when there's volatility in the market, not being afraid to stick and trust to your investment plan, ignoring the news, letting your portfolio work for you, trust that, if you're a client, we've built diversified portfolios for you to help provide value and do well in a vast majority of environments. So kind of trusting that and really resisting the urge to take out money if things get scary. I think, there's tons of research out there around that, and kind of letting your money work for you in the market. And these are just some things that you can do to help drive better success as an investor.
Absolutely. And Justin, you mentioned like that you very, very surely mentioned the, navigating the environment in which we exist. And just as you said that, it kind of got me thinking. You take companies like Facebook and Google, and when the Biden administration came along and there was an initiative of diversity and inclusion, well, all of them start putting in diversity and inclusion programs, and they did something because that was sort of like what they needed to do to navigate those days. Well, today, no, we don't need any diversity and inclusion. So basically, what are they doing? They're like, oh, we don't need this anymore. So they're navigating times the best they can. And I don't believe that deep in my heart, I don't believe that Google has a particular view on whether we should call Gulf of Mexico, Gulf of America. But from their perspective, it's like, we just need to get through and make sure that we don't get into hot water. So if it means that we're going to put it on our map as Gulf of America, great. And some people are going to feel fantastic about it. Some people are not. But ultimately, it's about the companies in which we buy ownership trying to navigate times. And that's where I get my confidence in the investment plan that Greenspring has, is that you are buying ownership in companies that will find a way to navigate, and they'll be flexible.
Yeah, great.
Resilient.
Yep, great points. All right, so we're about 15 minutes left in our discussion today. Looking through kind of the list of questions that we were sent beforehand, I think one theme that I can pull out from this are questions around how to mitigate market downturns. Regardless of if you think, right now is going to be a more severe downturn than it is. I think, before today, the US market was down a couple percentage points. I think that's normal relative to history when we look at markets. But regardless of if you think this downturn worsens or if it's just more of a blip on the radar, I think we can agree that at some point, whether it's 1, 3, 5, 10 years, there's going to be another downturn in markets. That's how investment markets work. So what can investors do now to help prepare them for potential drawdowns, especially for those that are at or near or in retirement?
Oh, absolutely. And I want to actually visualize exactly what you said. You're talking about that at some point we know there's going to be a market downturn. That's just the nature of the markets. It's pretty much, I live in LA, and I know at some point there'll be an earthquake. I'm under no illusion I'll live my whole life without an earthquake. I just don't know when. And I think it's kind of the same idea with the markets. And if you look historically, I think it would be, useful to visualize that. You look at the S&P 500, which is the measure of the U.S. stock market over time. What you see is that there are times when we have what's called a bear market. And a bear market is when we see a drop of 20% or more. And if you look at the history of the market, going back about 100 years, what you see is that you have times, and these are, when in yellow, when we do have this bear market. So it does happen, and it's absolutely true that it's going to happen again at some point. So these bear markets absolutely do happen. But what's so interesting, Justin, is that as much as we studied this, there's no reliable way to tell you when are they coming. The same way that I don't know when the earthquake's coming in LA, I don't know when the next one is coming here. Now, the good news, as you can see visually, is that the flip side of a bear market is a bull market, when the market goes up and you make money. And if you look historically, these bull markets have happened, much more often, but also absolutely for longer periods of time. So while we do see bear markets and they don't happen nearly as often as the bull markets, and investors who are actually disciplined to the point that you're making certainly benefited from that. So ultimately, how do you protect against these downturns? How do you protect yourself against times when it does drop? And it's really important to do. Well, I can tell you the one strategy that there are two different strategies, and I'll give them both. The first strategy is what investors have done for a long time, which is try to analyze the markets and try to figure out, should I be invested now or should I not be invested? And it even taken aside the emotion, you can look at the numbers and decide that, maybe that's time to get out of the market at some point. And I've tried it myself when I was in the PhD program, and I have great professors, data. I try to do that. And what I found, Justin, are two things that are hugely important. Number one, when you decide to get out of the market, you have to make an equally important decision at the same time. When do you get back in the market? And that's the hardest part, is not knowing when to get out, but when to get back in. Because 5 years ago, when we're all locked up at home, the market dropped about 30% in 6 weeks. People were panicked, and some sold saying, I need to get out. I don't want to lose my shirt on this. And it turns out that nobody knew when to get back in. And I've met plenty of investors who, by the end of the year, they were still deciding, when do I get back in? And they already took some of the losses. And what they missed was the opportunity to grow about 18%, because that's how much the S&P was up overall in 2020. So making these two correct decisions is incredibly, in fact, I don't know anybody who can consistently make those two correct decisions at the same time. The second reason, and I think this is really important, is that if you're trying to navigate the downturn by selling, you have to also consider that investing and life in general is not about certainty or guarantees, but it's much more about understanding your odds, statistics, and probabilities. Any business decision, anybody who's worth anything today is making decisions based on data and evidence and statistics rather than how they feel. So what does the data suggest about being invested versus not being invested in the market? And I recently was asked, about a year ago, I was asked to deliver a talk at a retirement community. They had this very big issue. I want to be protected. I need to know when to get out, when to get in. And as I try to understand the audience, it turns out that a lot of them were watching the market daily, very fearful of what's going on, but also they would play tennis afterwards to relieve the stress. So it was interesting for me to kind of like share some data with them that I think would be helpful for everyone. Because if you look at the US stock market, the S&P 500, whether it's last year or the last 50 years, what's fascinating, Justin, is that on average, on a daily basis, any given day, what you see is that roughly about 53% of all trading days in the market have been positive and 47% negative. Meaning that if you watch the market daily, it's a little bit of a flip of a coin. It's not obvious at all that you make money. Roughly half the days you lose money in the market. You have to be ready for that when you invest in the market. Any given day, it's almost a flip of a coin. You have a little bit better odds of making money, but not by a lot. So then what can he do? Well, one thing that he can do is basically give the market some time to work for you. And if you're patient enough to wait for the quarterly statements instead of the watching the market daily, then what you see, interestingly, is that the odds change. Now about 71% of the quarters over the past 50 years have been positive and only 29% negative. Meaning that simply switching your time horizon makes a huge difference in the outcome that you see as an investor. If you switch from daily to quarterly, much different odds. You're a lot more likely to see a positive quarter. And if you're patient enough to wait for the whole year, and you look annually over the past 50 years, what you see is that 78% of the years have been positive and only 22% negative. So which is so interesting, because what it basically suggests that one way to try to mitigate what's going on in the market is by not paying attention to it. The best way to think about it is not to think about it, and let some time, let the time work for you. And funny enough, I was trying to relate this to the other hobby they had, which is tennis. And I know Roger Federer is probably the all-time best male player. And I was curious to see from a statistical perspective, how do you get to be the all-time best? And what was interesting is that if you look at Roger Federer, not an average player, arguably the all-time best male player in tennis, what's fascinating is that Roger Federer won 54% of the points that he played in his career. He lost roughly half the points. The all-time best didn't get there by winning 80, 90% of the points. He won a little bit more than half, 54%. But if you give Roger some time and you ask, okay, I'll wait here the whole set, and you ask, well, what percentage of the sets did he win? Well, that number goes up to about 75% of the sets that he played in his career. And if you're really patient enough to wait for the whole match, he won about 81% of the matches that he played. Which is so interesting, because it's quite the same as the market. If the market drops, don't any one day, like you talk about today, don't panic anymore that if Roger Federer lost a point. It happens. Don't pack your bags and say, I'm going home, he lost a point. No, just that's par for the course. That's kind of how it works. But the more time you give Roger, the more time you give the markets, the better the odds become. Because the way that he got to be a champion, the way that you get to be a successful investor, is not by saying I need to win every day, but rather stick in there, play all the points, win the big ones, and that's going to get you to a championship. So the idea here being is that that notion that sometimes you hear that it's a good time to be invested and maybe I'm scared, I need to get out. It is not backed up by data. You are worse off doing that than staying invested for the entire time. So then how do you protect yourself? There are three ways. There are three ways that's the alternative to moving in and out. And the first way is to realize that you can counterbalance the equity ownership, meaning that the ownership that you get in companies, and you can counteract it with owning some bonds. And bonds are quite a different animal, and not every single period, but quite often. What's interesting is that these bonds that we talk about, they do in fact behave differently than stocks. So just to kind of give you a perspective over the past, since I just looked the last 20 plus years, there could be a year when in 2022, both the stocks and the bonds went down at the same time. And that was a little bit unusual, because what you typically see happening is in a year when the market dropped significantly, like it did in 2008, it was a 37% drop in the US market, bonds held up really well. And you kind of saw the same thing every single year that we had a negative outcome in the US market in the early 20s. So for the past 25 years or so, we had 5 negative years. And in those 5 negative years, 4 out of those 5, the bonds actually held up and had positive outcomes relative to the stock. So one of the things that you can do is have a counterbalance to stocks and in bonds. And that's why the mix between stocks and bonds tends to be the most important decision that you can make in a financial plan. The second thing that he can do is not only look in the U.S., but as as Justin talked about, have a global perspective. And today, if you look at the value of all companies that he can buy and sell around the world, the U.S. stock market tends to be the largest. And in that respect, the U.S. stock market is about 65%. When you add up the value of Apple, Google, Nvidia, Microsoft, Coca-Cola, McDonald's, you name it, about 65% of the value of all companies around the world is in the U.S. And that means that in a diversified, balanced portfolio, about 2/3 of the money is going to go into the US market. But what it means is that you can actually gain some diversification. And this is where you have about 10,000 plus companies in 40 markets. That's one way to counterbalance the risk of a US market dropping. And we've seen this in the past, where the U.S. market is going down and international markets go up. Not every time, but if you have a diversification piece in there, I think that can be hugely beneficial. So number one way to protect is have some bonds. Number two, have a global perspective to investing. And number three is to have a financial advisor who has a plan, and even more importantly, has a systematic way of taking the emotion out of investing. And when the market, for example, goes down, which it happens, instead of selling in panic, to actually look at it as an opportunity and buy. And the same when the market's running high, to at some point trim the gains, take some chips off the table, and then buy something with a better valuation. So the third way is to have an advisor with a plan and a process that is called rebalancing. And rebalancing means that you're always paying attention to the portfolio. Most days, the best course of action is not to trade, but at times it's really smart to either replenish the stock portion if it goes down, or replenish the bond portion if the stocks are running up. And do this very systematically, not based on an emotion, but something that was put in place systematically before we even get to that situation. So those are the three ways that I recommend to investors to mitigate market downturns. Have some bonds, international companies, and a process of rebalancing through a financial plan.
Yeah, those are great points, Apollo, and I agree with all of them for sure. So I think to wrap things up, there's a couple points I'd like to make that I think are important here. I think it's important to take a long-term perspective, zoom out from what you're seeing on the news. If you pull up the Wall Street Journal, you might see Tesla down 35% year to date, or Nvidia down 16%. Well, the good news for you as an investor and as a client is that your portfolio is not a single stock. You have thousands of stocks to help diversify your risk. So in reality, because we build these global diversified portfolios, like you mentioned, Apollo, while the S&P or the US market is down a little bit year to date, likely clients' equity portfolios are actually up because of that diversification that is intentionally put in their portfolio. So separating what you see on the news versus what you actually have from your investment portfolio. And then, as you mentioned, developing financial plans, very, very important. Leaning into them. If you have concerns at all, reach out to us. We're here to help. We're proactively every day, working to make sure that you have the best ability to reach your goals as an investor. But if we can help in any way with any questions, we're happy to do so. Like I said, we're monitoring portfolios daily. When there's opportunities to rebalance, we're doing so. And we're doing a lot of work behind the scenes to help make sure that you, as clients and investors, can deliver on your goals. So fears of downturns are definitely normal. But as I mentioned, if you have concerns, please feel free to reach out to us. And we're happy to meet and discuss to make sure that your plan still aligns with your goals and do anything at all to help out. I think we're right at time. So Apollo, this has been incredibly helpful. Definitely appreciate the time, the insights that you provided, and the conversation overall. And to everyone on the call, I hope you had a great time listening. Hopefully it was informative to you. Have a great rest of your week. If we didn't get to your questions, we're going to reach out to make sure that we covered your concerns and we're able to address those with you. Thank you for joining. And on behalf of everyone at Greenspring Advisors, we hope you have a great week. Thanks.
Bye-bye.